Hello, welcome to Jeff's World, the weekly 30-minute show where we cover key opportunities and risks for investors tied to developments around the world. And we do that so you can make more informed investment decisions. And we take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time, and we'll get to as many of those as we can in the second half of the show. I'm notorious for maybe only getting to a few of them, but I'll try and get to as many as I can today, I promise. And there's a few required disclosures before we even get started. Obviously, we don't know you personally, so we don't make personalized recommendations, but we do talk generally about what markets and sectors and areas of investing we think are likely to perform well or poorly and why, although we don't provide specifically an outlook on individual stocks. Clearly, things can and do change, so all our thoughts here are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind with our talk today. Now, I'm joined as usual in recent weeks by members of the global strategy team here at Charles Schwab. Good morning, Heather. Good morning, Michelle.
Morning, Jeff.
Good morning.
As usual, Heather will be watching the YouTube chat and those questions closely, and we'll get to those in about 15 minutes or so, about halfway into the show. But Heather, you're so good with questions. Why don't you kick us off with our usual kickoff question?
Well, Jeff, what are we watching this week?
Yeah, so here's what's going on this week. So last week, to set the stage, Fed Chairman Powell opted for a dovish 50 basis point rate cut and succeeded in not alarming markets, contrary to some predictions by a few out there that a jumbo rate cut would spark worries that the Fed sees a sharper economic slowdown coming. Sometimes when the Fed moves more aggressively, people go, what do they know that we don't? But instead, this 50 basis point rather than 25 basis point cut actually led to a stock market rally the next day and a decline in the market's fear gauge, the VIX. Nevertheless, though, if markets take Powell at his word and long-term yields continue to climb as they have since his press conference, it might lessen the rate cut's impact on the real economy. See, the rise in long-term yields may offset recent weeks' decline in mortgage rates. So rather than supporting the housing market, the immediate effect of the jumbo cut could be to further weaken it as it pushes longer term rates higher. So the problem is that housing is one of the most cyclical sectors. It needs more support, and we expect to see a decline in new home sales when they reported in the U.S. on Wednesday and pending home sales when they reported on Thursday. So housing is still a soft spot. In fact, I saw Liz Ann Saunders on Bloomberg TV this morning talking about the weakness in the housing market we're likely to see this week. Also, consumer spending due out Friday is also moderating here in the U.S. as consumers become more pessimistic about their job prospects, with consumer confidence from the Conference Board tomorrow and from the University of Michigan on Friday. Those are the two most closely watched consumer sentiment surveys conducted in the U.S. Now, data outside the U.S. includes the UK and Eurozone flash PMI surveys for September. They came in a little bit softer, particularly in services in France, some of that tied to just the end of the Olympics. So, services taking a little bit of a dip there after all that travel and entertainment spending. But they're basically unchanged on the manufacturing side, a little softer. And they're giving us a little sense of how growth is developing here in the third quarter. It's not booming. Growth is likely modestly positive in Europe in the third quarter, but certainly not getting a lot of help with Germany's slowdown in demand tied to what it's getting from China. Germany makes a lot of cars, a lot of other durable goods. China's a big customer of theirs, and with the consumers in China remaining fairly soft, that picture is not particularly bright. We're also going to get the IFO survey of business leaders in Germany. That'll be crucial to help gauge the near-term outlook as well. So a lot of that coming out this week. Also, the Reserve Bank of Australia is likely to hold rates steady this week, along with the People's Bank of China. They did cut the 14-day repo rate. But the policy rate in China is actually a one-year rate. It's the one-year MLF, and we don't expect them to be cutting that rate this week. But there is one rate cut on tap, and that's in Mexico. The Bank of Mexico, Banxico, as we call it, will likely cut rates following the Fed Reserve's outsized rate cut last week. The rate in Mexico is 10.5, is 11%, is nearly 11%. It'll be cut down to 10.5% on Wednesday, we think, with more cuts in the cards. So that'll be one central bank we'll keep an eye on this week.
Okay, Jeff, what about other central banks around the world?
So we had the Fed move last week. So that's the 12th out of 18 major central banks, advanced economy central banks. The IMF has this definition of advanced economies and developing economies, and there are 18 advanced economies. 12 of them have now cut rates now that the Fed's joined the party. But the Fed's late to the game, right? It was the 12th. So we're past the halfway point here in the number of central banks cutting rates, but it was a 50 basis point move. So kind of playing catch up a little bit here. We had two central banks hold rates steady last week. That was the Bank of England. They did cut once already. Now they're pausing in between moves. In Norway has not cut rates yet. I expect them to later this year. Most central banks are now on a slower path to cuts. Most of them started earlier. They're now skipping a meeting or two in between cuts. Most maybe skipping one meeting in between cuts. The Fed is not expected to do that. Also worth noting is that Brazil's central bank actually hiked rates last week. Now, over the past few years, Brazil has been leading other central banks. Hasn't always been the leader, but over the last few years, it really has. They were the first to hike in 2021 ahead of really all major central banks. And then that was about a year ahead of the Fed. And then they were the first to cut last year, about a year ahead of the Fed. So now they've started to hike rates again. So sort of interesting to see how, if indeed they continue to lead rates, what does that mean for the Fed a year from now? Hard to see where inflation is a year from now and what it might mean for central bank policy, but interesting to start thinking about this. The market always usually thinks, 6 to 12 months out in terms of what central banks are going to do, not just what they did last week. And so interesting here that if Brazil still acts as a sort of canary in the coal mine or a real leading indicator of about a year here, interesting to see that they're hiking rates again. Speaking of hikes, last week the Bank of Japan held rates steady. They did not hike last week. Governor Ueda pushed the likelihood of an October rate hike. So they didn't hike in September. Would they hike in October? Nah, he kind of took that off the table. Talked about caution over the yen carry trade unwinding back after they hiked rates in July. But I still think another hike is likely on the table later this year, very early next year, followed by another one. But there's a lot going on there, Michelle. What do you make of the Bank of Japan and the Fed and the move in the yen here lately?
Yeah, I think it's pretty interesting that expectations about Fed rate policy seems to be having a bigger impact on the yen than the Bank of Japan, which is kind of surprising. Markets, believe that the Fed may need to catch up after a later start to rate cuts. In our chart, you can see the relationship between the yen, that's in orange, and the difference between US and Japanese yields in blue. And that difference in yields continues to narrow. The key to that narrowing is that it's really been driven by the dramatic decline in US two-year yields, not a rise in Japanese yields. If we look back since the yen hit a 38-year low on July 3rd, US two-year treasury yields are down 112 basis points. But Japanese two-year government bond yields, they're just up by 1 basis point. Now, like as you mentioned, last week's Bank of Japan meeting, Ueda, signaled less need to hike in the near term, and that really could be due in part to a stronger yen, reducing the upside on CPI. But as Ryu said, the Bank of Japan isn't done hiking, with real yields still really very negative and accommodative. So we could see some more yen volatility possible in the near term, but it's really unlikely to look like what we saw in early August unless positioning becomes so extreme again. One thing that is, I think, interesting about all of this is that Japanese stocks are outperforming this quarter relative to the S&P 500. And that's despite the volatility in Japanese markets and the stronger yen that could reduce earnings for Japanese companies. And the reason is Japanese stocks are being supported by two really powerful trends. One is the move away from deflation, which can give companies pricing power. And the second is corporate reforms that are to the benefit of investors. And this outperformance for Japan and also international is outperforming. It really illustrates the importance of expectations and valuations, which are low in both cases. And the weaker dollar has also helped support returns. One more note as we look ahead this week to central bank action. Some central banks move in sync with the Fed, particularly when currencies are pegged to the dollar, or in the case where you have a very open economy where exports are more important than the domestic economy. So we could actually see the Swiss National Bank cut by 50 basis points this week. That would be their third cut this cycle. They only meet quarterly. And then we've also had central banks in a bunch of countries that peg to the dollar cut rates in conjunction with the Fed last week. And that would be Hong Kong. We've got Gulf countries such as Saudi Arabia, Bahrain, the UAE, and Qatar. That's, of course, all opposite of what Brazil did, which was raise rates. And so, the implication for stock investors is that there are really some country-specific developments and some divergence happening that could mute the benefit of a Fed rate cut cycle for the performance of emerging market stocks.
So with all of these different central banks cutting or raising, where exactly are we in the global rate cutting cycle, and what does that mean for investors?
Yeah, that's an interesting question, Heather. And what Michelle just talked about in terms of, the interesting move in 2-year yields. I mean, the market really believes the Fed, right? And really pulling that 2-year yield down, whereas not so sure about the Bank of Japan, and isn't really pushing 2-year yields up too much. Of course, the global economy is kind of softened a little bit here, and so some of that is playing into maybe keeping a lid on Japanese yields. But still, interesting to see how the market's, where it's sort of placed its chips here in terms of its bets. But the broad picture, 12 of the 18 major central banks have started cutting rates. The Fed just joined the party, but we've got rate cuts from the ECB. We've got cuts from the Bank of Canada, the Bank of England, among our other central banks cutting rates out there. More than half of them now have cut rates. And I think that's important because this morning we got the PMI numbers. Now, if you follow the show, I'm a huge fan of the Purchasing Managers Index survey of business leaders in manufacturing, and does an incredible job of forecasting 3 months ahead of time where earnings growth or earnings revisions are going by analysts. Does a real good job of giving us a real-time barometer of the economy. And in real time, we just got the September preliminary numbers here. We're in September, so it's a really great leading indicator. Wasn't so good for the month of September. Manufacturing in Germany and France slipped a little bit, and on the services side really pulled back. But I want to focus on manufacturing because that's the most cyclical part of the economy. It's also the part of the global economy that's been in recession, right? We talked about the cardboard box recession last year, starting to pick up this year. Well, manufacturing has slumped a little bit. It's not back to its lows in Europe, which were in July of last year. It's still well above those, but it's not above 50 yet. So still in kind of a contractionary environment. We're looking for it to turn around. And that's why this chart's so important. What this chart shows is the blue line is what central banks are doing. So it's the number of central banks cutting rates, that's when it's rising, and hiking rates, that's when it's falling. And the reason I kind of flip that upside down from what it might be intuitively is because that's how it leads manufacturing activity, right? So when it's a 9-month leading indicator, so I shifted that blue line out 9 months, and the orange line is this PMI, this survey of business leaders in manufacturing about their business prospects. So what you can see, it fits pretty well when I shift it out by 9 months. And what it's pointing to here is we've just crossed that threshold now with 11, now 12 of the 18 central banks cutting rates. So that line is now kind of crossed over zero, moving up. And I think by the end of this year, we could be around 15, 16 of those 18 major central banks cutting rates. That would, if the PMI follows that, then maybe by the middle of next year, 9 months from now, we could be looking at a PMI upwards of 53, 54, 55 on that manufacturing PMI, kind of right near the high end of where that line tends to get. And that's a really good environment for the stock market. Usually in that kind of an environment, we see stocks produce double-digit returns. They almost never fall when the PMI is rising from 50 to 55, because remember, along that, economic expectations are rising, earnings revisions are going up, it tends to support higher valuations. And so as this relationship suggests, stocks do well, and international stocks, which are more cyclical than U.S. stocks, tend to outperform. So I think this is a good sign. Yes, we're still in a soft spot economically outside the U.S. and now maybe a little bit inside in manufacturing, but we're seeing prospects for improvement over the next 9 months as more and more of these rate cuts that we started to see begin to be felt here in the manufacturing sector, Heather.
Oh, okay. Well, Michelle mentioned Japan outperformance. Are we seeing broad outperformance by international stocks?
Yeah, that's a good point. Here in Q3, international stocks are outperforming almost anywhere you look, due in part to the broadening of market performance from just a handful of AI stocks that really led the market in the first half of the year. And that, along with the weakness in the dollar, we're seeing the EFI index of international developed stocks post a quarter to date return of 6%, above the 5% return for the S&P 500 index. Financials is the best performing sector. That's for the EFI index, up almost, and that makes up a weight about twice as high in the EFI index as it does in the S&P 500. So that's contributed to strength. It's a rate cut beneficiary. Financials tend to do well when the yield curve is steepening up. And so we're seeing that there. And it's not just Japan. Germany is outperforming the US, German stock market, the Italian stock market, the Spanish stock market, the Canadian stock market, the UK stock market. They're all outperforming. So you can allocate away from a US tech concentration and not have to worry about picking individual countries. You can get broad international allocation, which is outperforming here, not by a tremendous amount, but outperforming here in the third quarter on an equal weighted basis. International stocks are outperforming this quarter as well, just as they outperformed last quarter. So I think there is this momentum towards international outperformance. We're really starting to see now that the AI stocks have taken a little bit of a pause.
Besides the interest in central bank activity, elections are a huge topic for investors this year. Are there any insights from the elections that have already happened or those that are coming up?
Yeah, so we all wrote a piece earlier this year that's on Schwab.com previewing all the elections this year. This is a record-breaking year for elections. I know we're obsessed with the US election, but more than half the world's population is voting this year, with elections in huge elections: Taiwan, South Korea, the Netherlands, Mexico, India, the EU, the UK, France, right? Lots of major elections this year. And I think the broad theme that we can take away from them and maybe apply to the Japanese election, which is coming up on the 27th, and the US election in November, is that we saw gains, generally speaking, by parties encouraging nationalist policies, my country first policies, I'll call them, and those that were touting fiscal deficit widening spending initiatives and tax cuts. Now, usually markets respond negatively to trade frictions and wider deficits because they have a potentially negative impact on growth and inflation. But in general, this year, they haven't. Even though we saw new governments following all those elections I mentioned in these major countries, we're not seeing really that follow through. A lot of campaign bark, but not a lot of bite out of markets. Candidates we know campaign on change, but not that much change policy-wise following many of the elections in 2024, despite a shift in the government. The major policy proposals by the winners during their campaigns saw actual little progress towards actual implementation, and that muted the potential market impact. And that might have some implications here as we think about the US elections. How much of that is actually going to get done in terms of what the campaigns are? I'll give you an example. In the EU, we saw these elections on June 9th, saw a big rise by populist parties, and the ruling coalition in Europe lost their majority in parliament for the first time ever. But rather than seeing sweeping changes in policy, the election actually resulted in a more fragmented legislature and more of a slow and complex policymaking process rather than major changes. And the populists in the EU Parliament are experiencing a change similar to what Italy's populist Prime Minister Giorgia Meloni, is coming to recognize as she finishes her second year in office. How do you balance these generous campaign promises while still shrinking a bloated budget deficit? And how do you manage trade relationships that don't end up backfiring? So this is really what we're seeing. That I think the main takeaway from these many elections in 2024 so far is that actual policy may be more often dictated by economic circumstances than the proposals offered by candidates, and that investors have been wise to recognize that the campaign bark often means little bite in terms of actual market impact of policy. So that, again, important to keep in mind as we all start to think about election trades ahead of the election. I'd really dial that back because I think we're in a legislative environment that makes sweeping changes very hard no matter who wins these elections.
That's great. Why don't we talk about some questions here? We've got a few coming in, and I do recommend that everybody go ahead and participate if they want us to address their questions today. The first question we have is commenting of any views on the strength or weakness of the US dollar and the yen and its effect on the world markets.
Yeah, well, I'll kick that off, and then Michelle, you may want to join in. So, in general, usually when the dollar is rising, it's often in an environment where the world is seeking a safe haven. Economic growth might be slowing, and the market retreats to buy treasuries and the safest instruments, and so the dollar tends to go up. The other time is when the Fed is either hiking rates faster than the rest of the world or keeping rates higher as the rest of the world is cutting. So we've had a combination of these factors lately. Weak economic growth last year in the rest of the world, while the US did a little bit better, and that brought money to the US. And at the same time, the Fed was positioned to keep rates higher for longer, and that supported the dollar last year. We've seen a slump this year in the dollar, not a dramatic one. The dollar's down just slightly this year. Often people ask us about the dollar and whether they should factor that into their investment decisions. The dollar really hasn't moved dramatically either last year or this year. It has against the yen, of course, so some countries have seen dramatic moves, but overall, it's been fairly muted. And I think in general, the dollar sort of follows what we're seeing in terms of momentum in rates and economic activity. Now that we're seeing the Fed committing to a more dramatic rate cutting path, that suggests strength in the dollar. Also, if we're right about these rate cuts beginning to lead to better economic outcomes as we look to next year, particularly outside the U.S., then maybe that suggests that the dollar may continue to weaken as well. So our view is generally the dollar's probably not going to make big moves in either direction over the next year or so, but might be more biased towards lower directions, kind of our formal outlook on that. But Michelle, in terms of the dollar and the yen, there have been some dramatic moves this year. Maybe give us a little bit of a background on that and a little bit of what we see on that move going forward.
Yeah, first I'd say that the dollar's been in a bull market for the past 10 years.
Yeah,
if you look at the Dixie, the dollar index. And so, yeah, it's possible to see further downside. But I would say that the difference in yields, there's still higher yields in the US. So any kind of decline is likely to be, muted. It's not going to fall too far too fast. Relative to the yen, again, it was just in July, we had a 38-year low in the yen. And the yen, you could argue, is still pretty weak. It's gone down. The dollar has fallen and yen risen from 160 to 143. But, if you look back to when the Fed started hiking rates in March of 2022, dollar yen was 115. So there could be further downside. Now we've had a big change in sentiment toward dollar yen in the last 2 months. We went from a very extreme net short position in speculator contracts to now people are net long yen. So any kind of volatility is unlikely to look like it did in early August. But that's really kind of more of the short-term speculators. But we could still see some, decline as people move away from the yen the yen carry trade in the medium and longer term.
Yeah, so interesting. So when we talk about the yen going down, or down even towards 115, that's actually strengthening the yen, correct? Because it's fewer yen per dollar. So it's kind of weird to think about a little bit, but but yeah, is room for more yen strengthening here. One thing I just pulled up the valuation of the yen on a purchasing power parity basis from the OECD, still 30% undervalued. It was nearly 40% undervalued. So big move in the yen, but still relative to the dollar suggests there's potentially more moves there. Obviously, looking out, who knows exactly what the Bank of Japan is going to do next year, or even what the Fed's going to do next year. But given the path that they're on, rates in the US are still much higher, but they're coming down. So at the margin would tend to support the yen there in the near term. But overall, the dollar probably headed in a softer direction, a benefit to investors, US-based investors, on their non-US investments. They translate back into more US dollars.
Okay, Jeff. Well, with a softer dollar and lower Fed rates, how might that affect the interest payments on our national debt and its demand across the world?
We do have a lot of debt that is shorter term. So as short-term rates come down, the burden of interest payments fades a little bit. At the same time as inflation comes down, the cost of that debt is retained. So inflation erodes the value of debt over time. Lower inflation means the value of that debt, the overall amount of that debt isn't being eroded at the same time. So it's a little bit of a give here and take there. But yeah, in the meantime, it should have a marginal impact on the cost. The problem is we're growing the deficit so rapidly. So even though we're paying a little less in interest, we are adding more and more and more to that debt burden every year, offsetting that. So don't expect the amount we're paying in terms of interest expense to really come down that dramatically, being offset by, of course, the larger base that the interest payments will be based on.
Okay. Well, there are some indicators that are indicating that we might have a recession by the middle of next year. How much of a possibility do you think that is, and what are some of the dependencies on that?
So, most of the world is coming out of a recession last year. I talked about a cardboard box recession, and those economies more tied to manufacturing really suffered last year as manufacturing was in a downturn. Economies like Germany suffered recession. Japan suffered a recession, back-to-back quarters of negative GDP. Europe was in recession. The U.S. skirted that because 9 out of 10 jobs in the U.S. are services jobs. The U.S. is a much more service-oriented economy, and services were doing great. You can just ask Taylor Swift how great services were doing last year with all the travel and entertainment, concert spending, all that stuff. That started to slow. Services have come down a little bit, so the U.S. economy has softened a little, whereas manufacturing is starting to turn around. And should turn around here over the next several months if the PMIs track interest rates as they usually do. So brighter outlook maybe as we look around the world for maybe more stable economic growth, whereas in the U.S. things are slowing because the service elements are slowing down a little bit. That said, we don't see an outright recession. A lot of that's going to be dependent on the labor market. Again, a lot of jobs in the U.S. tied to services. So if services continue to slow, people traveling less, spending less, going out to eat less, all that kind of stuff, we could see that begin to affect the job market and consumer confidence, and see a broader slowdown in the U.S. We'll have to see where that goes. We do expect the labor market to continue to slow. I think for the last 5 job reports, less than 150,000 jobs created here in the U.S. That may continue to slow, but maybe not outright job losses that would suggest a sharper pullback in consumer spending and a dip into recession in the U.S. But nevertheless, maybe a slower trajectory for growth in the U.S., whereas maybe a firmer outlook for growth outside the U.S. So thanks, Heather, for those questions, and everybody who contributed. Thanks to our producers, Andrew and Gabe and everyone for the questions. Of course, Chris as well. And thanks for those questions and for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. Be sure to like the show and share your comments on what you're watching that could move the markets. And of course, we'll see you again next week.